Today, I'm going to be unpacking the Greater Melbourne real estate market. As you probably know, the market in Melbourne in 2025 is lagging behind the rest of the country in terms of price growth. In this video, I'm going to clarify the current market conditions and trends in Greater Melbourne, and this is going to help you understand why Melbourne is lagging. I'm also going to provide some insights on the future direction of the Melbourne real estate market. A quick overview first. We're going to first look at the Greater Melbourne market as a whole, starting with the supply and demand metrics for housing. We'll then look at price growth and trends, and also the rental market. Next, we'll unpack the data for each of the city councils in Greater Melbourne so that you can see how market conditions vary from the different markets within Greater Melbourne. We'll then finish up by looking into the future at the future supply and demand of housing, and this is going to help us understand the likely direction of the housing market over the coming years. As always, we start with supply and demand. We do this because price and price direction make a lot more sense when you have an understanding of the drivers of price direction, which is supply and demand together. Here, we can see that supply of housing in Melbourne is relatively high and at a level that is higher than most of the last 20 years. In more recent months, supply levels are starting to trend lower from a peak here in October 2024, but as it stands today, supply levels in Melbourne are high. Looking at the demand side, recently we can see that demand levels are lower than supply levels, and the gap between supply and demand is wider than it has been compared to this period over in 2021 to 2022, where demand levels were much closer to supply levels. As you'll see in a few slides, during this period of 2021 to 2022, the market in Greater Melbourne was in a strong growth phase, but since 2022, demand levels fell faster than supply levels, creating oversupplied conditions. That said, there has been some movement over the last 5 months that suggests the current oversupply conditions may be changing. We have demand trending higher from this low point in mid-2023, and we have supply levels starting to drop from this high point in October 2024. If these trends continue, Greater Melbourne should become less oversupplied, potentially even undersupplied. Now let's look at some key metrics of supply and demand, starting with inventory levels or months of stock. Here, we can see inventory levels are trending lower from this peak in August 2024, and this is an indication that the market is trending away from being oversupplied. Another key metric is median days on the market. Here, we can see that this metric has been trending higher from a low point in February 2022, and it's currently at a cyclic high. That said, this metric has not increased above 35 days since October 2024. So with inventory levels falling, and a stable median days in the market, this suggests Melbourne's oversupply has peaked, or in other words, the oversupply is not getting any worse. Before moving on, check out this period of low inventory levels and low median days in the market during 2021 to 2022. Keep this in mind for the next slide. Next, looking at the median price of houses and the annual growth rate. Let's start off by looking back at this period over 2021 to 2022, where Melbourne was undersupplied. It was during this period that Melbourne was undergoing a strong growth phase, reaching a peak annual growth rate of 16.6% in December 2021. However, as we saw in previous slides, after 2022, supply levels started to exceed demand levels, and the growth rate in Melbourne started to decline. Melbourne's annual growth rate actually went into negative territory in March 2023. That growth rate hit a low point in August 2023 and then started to rebound back towards positive territory. The annual growth rate briefly touched 0% in June 2024 before heading back towards a negative. This suggests that while previous supply-demand metrics indicate the oversupply conditions are improving from peak levels, the overall market in Melbourne is still oversupplied, and there is still downwards pressure on price. Next, we look at the median house price over the different intervals of 12 months and 3 months. As mentioned in previous videos, there are pros and cons to looking at this over a long period like 12 months and a short period like 3 months. For example, the median house price over a long period like 12 months is stable, but it has more time lag. And the median house price over a short period like 3 months is more volatile, but it may better reflect recent market conditions. Both are useful to analyze. Anyways, here we can see the median house price in both intervals is still trending lower, including the 3-month median price. Eventually, when the market in Melbourne reverses course back to the upside, we should see this 3-month median price start to swing upwards before we see the same in the 12-month median price. But we don't see this yet. Okay, looking at the different price segments of lower, median, and upper, this view is quite interesting because we can see that it is mainly the upper price segment that is struggling and quite a bit down from a peak. In fact, this drop in median price in the upper segment is a decrease of around $100,000, whereas the drop in median price of the lower segment is only $20,000. And this suggests that the more affordable markets in Melbourne have been more resilient over the last few years than the higher price segments. Let's move on to the rental market, starting with median rents. Here, we can see that the rental market, unlike the broader housing market, is not having any issues with oversupply. Median rents have increased 30.7% over the last 3 years, and this works out to an average annual increase of 9.3%, which is relatively high. Looking at rental growth history, we can see that the rental growth rate peaked in May 2024 at 14.6%, and that the growth rate has been slowing since, having recently recorded a growth rate of 8.5% per annum. Still, 8.5% is a relatively high growth rate, and for context, the current rate of inflation is only 2.4%. Looking at the rental yields for the city, there is an interesting situation happening in Melbourne today when it comes to rental yields. Due to this combination of stagnant house prices and high rent growth, the rental yields in Melbourne are recording a strong growth trend for the first time in 20 years, unlike most of the other major capital cities where house price growth is outpacing rent growth, which results in a decline in yields. So Melbourne is bucking the national trend when it comes to rental yields. We're now going to unpack these market metrics down to the city council level. This heat map shows all of the LGAs in Greater Melbourne, and I've also included the LGA of Geelong. While technically not part of the Greater Melbourne official boundary, Geelong is connected to Greater Melbourne geographically, and the real estate market in Geelong behaves in a very similar way to some of the other LGAs on the outer boundaries of Greater Melbourne. So we'll start by looking at median house prices. The most expensive city councils in Melbourne are the LGAs along this inner ring on the east side of Melbourne CBD, and the most affordable LGAs are to the north and the west, in city councils like Mitchell and Knowlton. Looking at the annual growth rates of median house price across the city, we can see that there's some LGAs that have actually recorded positive median price growth over the last 12 months, such as the LGAs of Banyule and Moonee Valley at around 4.2 to 4.7% in annual growth. And while this is a relatively low growth rate compared to some other markets in Australia growing at 10 to 15% per annum, relative to other LGAs in Greater Melbourne, the market in Banyule and Moonee Valley look pretty healthy. We can also see some other locations where the annual growth rate is above zero, such as the LGAs across the northern ring here and on the eastern corridor towards Cardinia here. Next, we'll look at quarterly growth rates of median house prices. Here, we can see a different picture compared to the annual growth rates. For example, the LGAs of Banyule and Moonee Valley had relatively high annual growth rates, which we saw in the previous slide. But in this video of quarterly growth rates, the LGA of Banyule is negative 0.7% in quarterly growth, and Moonee Valley is 0%. This suggests that the markets in these two locations are starting to cool based on data from more recent market conditions. You may remember from an earlier in this video, we saw that the market in Greater Melbourne as a whole is still in a state of oversupply, and there is still downwards pressure on prices. So it's not surprising that we see most of Melbourne showing quarterly growth rates in negative territory or close to zero. Okay, next we're going to look at the supply and demand metrics across the city, starting with inventory levels or months of stock. As a reminder, a low inventory level or low months of stock suggests a market that is more undersupplied and vice versa. So in general, markets with an inventory level of 1 month or less would be considered undersupplied, and markets with an inventory level of more than a month, such as 1.5 months or 2 months of stock, would be considered oversupplied. Here, we can see that there are some regions in the city where there is a relatively low level of inventory. And we can also see the regions where there are relatively high amounts of inventory, especially on the outer boundaries to the north, west, and east. Another useful supply-demand metric is median days on the market. This isn't the exact same picture as inventory levels, but these two metrics complement each other to provide a fuller picture of supply and demand. Here, we can see that the LGAs to the north, the northwest, and the west have relatively higher median days on the market of anywhere from 35 days to even 59 days up here in Mitchell LGA. On the eastern side of the city, we have some pockets with relatively low median days on the market of less than 30 days. So when we combine both pictures from the inventory levels and the median days on the market, the regions that are most undersupplied, at least in the context of Greater Melbourne, are the LGAs on the eastern side of the city, and the LGAs that are relatively oversupplied are the regions to the north and western side of the city. And if you live in Melbourne, this will probably make sense to you because you'll know that the north and western parts of Greater Melbourne are where the building industry has been most active in building new housing over recent years. And we saw earlier that from 2022, there was a big decrease in demand. And so you got these regions in Melbourne where there were high levels of supply coming into the market. At the same time, demand was falling sharply, thus creating the oversupply conditions that we see today in many parts of Greater Melbourne. All right, let's move on to the rental housing market, starting with median rents. Here, we can see the locations with the highest median rents are on the eastern, inner, and middle rings of the city, and the regions with the most affordable rents are to the north and western outer rings of the city. Looking at rent growth, the regions with the highest annual growth rates in median rent are the LGAs along this northern and western middle ring locations, as well as the city councils on the outer ring to the east. When it comes to rental yields, we saw earlier that the current rental yield for Greater Melbourne average was 3.5%. And there are some locations in Melbourne where the rental yields are relatively high at 4.0 to 4.3%. If you're familiar with the history of rental yields in Melbourne, you'll know that a rental yield of over 4% is very good. The last time Greater Melbourne had a rental yield of 4% was 15 years ago. So there's a scenario in Melbourne in 2025 where the rental yields are unusually high due to this combination of a growth in rents and a stagnation in house prices. We'll wrap up these heat maps by looking at the vacancy rate, which you probably know is a useful indicator for the supply and demand of rental housing. A vacancy rate of over 3% suggests a rental market that is potentially oversupplied, and a vacancy rate of under 3% indicates a rental market that is undersupplied. Here, we can see that the most undersupplied rental markets are in this inner ring and this middle ring to the east of the city. We're going to finish this analysis by looking into the future, starting with housing demand from population growth. This chart here shows the 15-year forecast for all of the LGAs included in this analysis, starting from 2021. Today, we're going to focus on just the 5-year forecast from 2026 to 2031. This population forecast expects the population of Greater Melbourne to increase by 538,000 new residents over the next 5 years to reach a total population of 6.1 million people by 2031. Now, to accommodate all of this new residents with housing without utilizing current supply, the number of new dwellings required is 207,000. I used Greater Melbourne's average household size of 2.6 people to derive this new housing estimate. We saw earlier that the housing market in Melbourne is currently oversupplied, so there is some existing housing capacity that can absorb some of these new residents. And in a moment, we'll be looking at the new housing pipeline to see if future supply will be able to keep up with future demand. When we unpack the population forecast down to the LGA level, we can see locations where there are some relatively high forecast growth rates. For example, the LGA of Mitchell to the north has a forecast average annual growth rate of 6.4% over the next 5 years, and this is significantly more than the average of 1.8% for the city. Other notable LGAs are on the outer ring here, like Milton and Wynnum, and Cardinia LGA to the east. Now, to look at future supply, we look at building approvals. Here, we can see the combined building approval history for all the LGAs that we've included in this analysis. First, we can see that the building approvals have been on a downwards trend since a peak around 2018. This period of relatively high building approvals from 2015 to 2021 explains why Melbourne currently has relatively high levels of supply. We can also see that since 2022, building approvals have decreased significantly to 10-year lows at a bit less than 37,000 new dwellings approved. This level is well below both the 10-year average and the 5-year average. It's also below the level required to accommodate the forecasted new residents from the population increase over the next 5 years. If you remember from the previous slide, Melbourne needs around 207,000 new homes over the next 5 years. If we divide that over a 5-year period, it's a bit over 41,000 new homes required each year. So if current trends continue with high population growth and low future supply, then it is highly probable that the market in Melbourne will transition from being oversupplied to being undersupplied, putting upwards pressure on prices and triggering the next growth phase in Melbourne. All right, last map for the video. Here, we can see the building approvals for the last 2 years for each of the city councils in our analysis. Assuming all dwellings approved over the last 2 years reach completion, this is what the future supply looks like across Melbourne. We can see some relatively large numbers of new supply in around Milton and Wynnum over in the west, and Casey City Council in the east. But remember, these are also the LGAs with higher than average population forecasts. So in summary, we saw that the market in Greater Melbourne as a whole is oversupplied, and this is putting downwards pressure on prices with the annual growth rate heading into deeper negative territory over the last few months. But I want to point out that most real estate markets in Australia have gone through periods of oversupply and undersupply throughout the recorded history that goes back around 45 years. These phases of oversupply and undersupply create the market cycles where house prices go up, down, and sideways. So there is nothing particularly unusual about what's happening in Melbourne today, except that the city is in the oversupplied phase of the market cycle. If anything, these conditions create opportunities to buy Melbourne real estate estate at a better value entry point compared to 1 to 2 years ago. And we saw that the trends for future demand and supply suggest that the Melbourne market will eventually become undersupplied. And this will trigger the growth phase of the market cycle. So I'll be closely watching the market in Melbourne on this channel. Make sure you subscribe to stay updated with the latest market trends.